Welcome to Knowledge Unlimited. I'm Chris Arnold, and in this session, we're going to delve deep into the world of quality investing, a strategy that focuses on long-term wealth creation with top-tier stocks. Let's start by understanding what quality investing really means. This strategy centers around investing in companies that demonstrate strong and sustainable business models, consistent profitability, and effective, reliable management. Unlike high-risk speculative investing, quality investing emphasizes long-term stability and resilience. So, why should you consider quality investing? The answer lies in its focus on enduring value. Companies that qualify under this strategy tend to be more resilient during economic downturns, which makes your investments more secure against market volatility. This approach seeks to provide a pathway to steady, long-term growth and wealth accumulation. This is an investment philosophy for long-term investment, with the safety of index funds if executed correctly. Now, let's identify what makes a company a quality company. There are several hallmarks to look for. A strong balance sheet is paramount. It indicates low debt levels and robust cash reserves. Consistent earnings growth is another critical marker, showing that the company isn't just maintaining its market position, but is actively expanding and succeeding. But there's more. A competitive advantage, whether it be through innovative technology, brand strength, or market dominance, can set a company apart in its industry. This moat around the business defends it against competitors and economic shifts. When evaluating quality stocks, it's not enough to glance at the financials. A deeper dive into the company's operations is necessary. Look at metrics like the return on invested capital and return on equity, but also delve into the company's debt levels, dividend history, and the efficiency and experience of its management team. Understanding the broader business context is key to making informed decisions. However, it's important to be aware of the risks and rewards associated with quality investing. The primary risk lies in overvaluing quality stocks. Even the strongest companies can become poor investments if purchased at excessively high prices. This is why it is important to look at valuation ratios such as price to earnings or enterprise value to earnings before income and taxes when timing your investment. On the flip side, the rewards can be significant. Quality stocks typically offer stability and the potential for consistent returns, serving as a robust foundation for your investment portfolio. Getting started with quality investing requires a blend of research, strategy, and patience. Begin by immersing yourself in market analysis. Identify companies that exhibit the qualities we've discussed. Diversify your investments across various sectors to mitigate risk. Remember, quality investing is not about short-term gains. It's a strategy focused on building sustainable wealth over time. You are investing in companies that enable you to buy and forget stocks, spending your time increasing your income and, in turn, your investment capital long-term. If you manage to invest properly into quality companies, you will get the same peace of mind as when you invest in a global index fund, but with potentially much higher returns. In conclusion, quality investing is about choosing companies that have demonstrated success and resilience and investing in them for the long haul. Each investor's journey is unique, and what works for one may not work for another. Stay informed, remain disciplined, and you're more likely to enjoy a successful investment experience.